Question 671. On the sale of a business, which of the following items would incur sales tax? A. Furniture. B. Goodwill. C. Fixtures. D. Both A and C. Correct answer is D. Both A and C. In California, the sale of a business can involve the transfer of various types of assets, and whether sales tax applies depends on the specific nature of those assets. Generally, sales tax applies to the transfer of tangible personal property in the sale of a business. Here's a breakdown of items that would typically incur sales tax. Tangible personal property. This is the key category. It includes items that can be seen, touched, and moved. Examples in a business sale include 1. Inventory. Goods held for sale in the ordinary course of business. 2. Furniture and fixtures. Desks, chairs, display cases, shelving, etc. 3. Equipment. Machinery, computers, cash registers, tools, etc. 4. Vehicles. Delivery trucks, company cars, etc. 5. Supplies. Office supplies, cleaning materials, packaging materials, etc. Items that typically would not incur sales tax. 1. Intangible assets. These have value but are not physical. Examples include plus, goodwill, the reputation and customer relationships of the business. Plus, trademarks and patents, intellectual property rights. Plus, copyrights, legal rights to creative works. Plus, customer lists, information about customers. Plus, non-compete agreements, contracts restricting the seller from competing. 2. Real property. Land and buildings are generally exempt from sales tax but are subject to property taxes. 3. Services. The transfer of services is generally not subject to sales tax, although the sale of tangible personal property as part of a service might be. 4. Certain exemptions. There might be specific exemptions depending on the nature of the business and the assets being transferred. For example, certain bulk sales of inventory might have specific rules. In summary, when selling a business in California, sales tax will generally apply to the tangible personal property included in the sale, such as inventory, furniture, and equipment. Intangible assets and real property are typically exempt. Goodwill, being an intangible asset, is usually exempt from sales tax. It's always recommended to consult with a tax advisor or the CDTFA for specific guidance on a particular business sale. Question 672. A major advantage of an investment in real estate over the stock market is A. Appreciation. B. Depreciation. C. Interest rate decline. D. Like-kind exchanges. Correct answer is B. Depreciation. Real estate investors can deduct a portion of the cost of their income-producing property, excluding land, over its useful life. For residential rental property, this period is typically 27.5 years, and for commercial property, it's 39 years. This non-cash expense reduces taxable income, leading to significant tax savings for investors. Stocks and bonds do not offer a similar depreciation deduction. Investors in these assets can only realize a gain or loss when they sell the investment. The depreciation deduction can create a situation where an investor has positive cash flow from a property but shows a lower taxable income, or even a loss on paper, further enhancing their overall return. While like-kind exchanges offer a powerful tax deferral strategy, depreciation provides an ongoing tax benefit that directly reduces an investor's taxable income year after year, which is a distinct advantage real estate holds over the stock market. Both real estate and stocks can appreciate in value over time. While real estate appreciation can be more stable, historically, the stock market has often provided higher average returns. Question 673. Once a listing agreement is signed, a fiduciary relationship exists between the A. Broker and seller. B. broker and buyer. C. Broker, buyer and seller. D. No fiduciary relationship exists. Correct answer is A. Broker and seller. Typically, the seller's broker has a fiduciary duty to the seller, not the buyer. The buyer is usually considered a customer to the seller's broker, to whom the broker owes duties of honesty and fair dealing, but not the full range of fiduciary duties. The buyer is usually considered a customer to the seller's broker, to whom the broker owes duties of honesty and fair dealing, but not the full range of fiduciary duties. A buyer can establish a fiduciary relationship with their own buyer's agent by signing a buyer representation agreement. A single broker cannot simultaneously have a full fiduciary duty to both the buyer and the seller in the same transaction without informed consent and a clearly defined dual agency relationship. Even in dual agency, the fiduciary duties owed to both parties are modified due to the inherent conflict of interest. A listing agreement explicitly establishes an agency relationship, which by law creates fiduciary duties on the part of the broker towards the seller. A fiduciary relationship is one of trust and confidence where one party, the fiduciary, is obligated to act in the best interests of another party, the principal. Once a listing agreement is signed, the seller becomes the principal, and the broker, and their agents, become the fiduciary. The broker has a legal and ethical duty to act in the seller's best interests, to be loyal, to disclose relevant information, to account for funds, and to exercise reasonable care and diligence. Question 674. A provision in a security instrument stating that the instrument will have a lower lien priority than another mortgage or deed of trust is called a acceleration clause, B. Secondary lien position clause, C. Subordination clause, D. Priority positioning clause. Correct answer is C. Subordination clause. Acceleration clause allows the lender to demand immediate payment of the entire loan balance if the borrower defaults on certain conditions, such as failing to make payments. It does not relate to lien priority. While secondary lien position clause describes the outcome of a subordination, it's not the name of the clause itself that dictates the change in priority. Priority positioning clause is not a standard term used in security instruments to describe the agreement to alter lien priority. A subordination clause in a mortgage or deed of trust is a provision that allows a later recorded lien to take priority over an earlier recorded one. This is commonly used in situations like 1. Refinancing. When a homeowner refinances their first mortgage, the new lender usually wants to be in the first lien position. A subordination clause in the original mortgage allows it to automatically become junior to the new, refinanced mortgage. 2. Home equity lines of credit, HELOCs, or second mortgages. These are typically junior liens to the first mortgage. The first mortgage often contains a subordination clause that anticipates and allows for these subsequent liens to be in a lower priority position. 3. Development loans. A lender providing financing for the development of land might require a previously recorded blanket mortgage to be subordinated to the new construction loan. Therefore, the specific provision that establishes a lower lien priority for a security instrument compared to another is called a subordination clause. Question 675. A salesperson must have with a broker that the salesperson that covers supervision of licensed activities, duties and compensation. A. Basic understanding. B. Signed, written agreement. C. Mutual stake in ownership. D. None of the above. Correct answer is B. Signed, written agreement. In California, a real estate salesperson must be employed by and work under the supervision of a licensed real estate broker. This relationship is legally required to be documented by a signed, written agreement. This agreement outlines the terms of their association, including 1. Supervision. How the broker will oversee the salesperson's licensed activities to ensure compliance with real estate law and ethical standards. 2. Duties. The responsibilities of both the broker and the salesperson. 3. Compensation. How the salesperson will be paid, e.g., commission splits. 4. This written agreement protects both the salesperson and the broker by clearly defining their roles and responsibilities. While a good working relationship requires understanding, a formal, legally binding agreement is necessary. A salesperson does not need to have an ownership stake in the brokerage. They are typically employees or independent contractors. Question 676. A deed is required to A. Be signed by a legally competent grantee. B. Include a legal description of the property being conveyed. C. Be signed by a legally competent grantor. D. Include the history of prior ownership of the property dating back at least 25 years. Correct answer is C. Be signed by a legally competent grantor. A legal description is essential for the deed to be effective in conveying a specific property. It is not always legally mandated for the validity of the deed itself in all jurisdictions. Similarly, the grantee's signature is typically not required for validity, and the history of prior ownership not being a requirement. Therefore, the single absolutely essential element listed for a deed to be valid and effectuate a transfer is indeed be signed by a legally competent grantor. Without the signature of a legally competent grantor, the deed is generally void and no transfer of ownership occurs. Question 677. A tenant with a lease to reside in an apartment building asks the landlord to repair the furnace that provides heat for all the units in the building. The landlord ignores the tenant's repeated requests. It is winter time and very cold in the building. In reaction, the tenant decides to stop paying his monthly rent until the landlord does the repairs. A. Legally in the right. B. Legally in the wrong. C. Authorized to check into a hotel and have the landlord pay the bill. D. None of the above. Correct answer is A. Legally in the right. The tenant legally in the right, under the specific circumstances described, to halt rental payments to the extent their use and enjoyment of the premises has been significantly impaired by the lack of heat. California law implies a warranty of habitability in all residential leases, requiring landlords to maintain the premises in a condition fit for human occupancy. This includes providing essential utilities like heat. When a landlord fails to fulfill their obligations under the lease, such as the implied warranty of habitability, making the premises uninhabitable, the tenant may have grounds for constructive eviction. Tenants' actions for constructive eviction. To claim constructive eviction, the tenant typically needs to 1. Notify the landlord of the defective condition, lack of heat. 2. Give the landlord a reasonable time to repair the condition. 3. Vacate the premises if the landlord fails to make the necessary repairs within a reasonable time. The tenant may remain in possession and halt rental payments according to the degree their use and enjoyment has been impaired. This is a significant aspect of constructive eviction remedies in California. The reduction or cessation of rent is tied to the extent the uninhabitable condition diminishes the value of the tenancy. Due to the uninhabitable lack of heat in winter and the landlord's ignored repair requests, the tenant may be legally justified in withholding rent, proportional to the diminished habitability. Question 678. Which of these expenses would not be included in the Uniform Settlement Statement form provided to the parties after a RESPA-covered transaction closes? A. Appraisal fee. B. Finder's fees paid to a lender by a broker. C. Title insurance fee. D. Pest inspection cost. Correct answer is B. Finder's fees paid to a lender by a broker. The closing disclosure is designed to clearly itemize all charges imposed on the borrower and the seller in connection with the real estate settlement. It focuses on costs directly related to the transaction and paid by the buyer or seller. Finder's fees paid by a broker to a lender are an arrangement between those two parties and are not a direct cost being paid by the buyer or seller as part of the settlement. Finder's fees from broker to lender, though potentially affecting borrowing costs, are not settlement charges disclosed to buyer and seller on the closing disclosure. Finder's fees are illegal under RESPA. Question 679. Complete title to a property can be transferred with A. Trust deed, B. Grant deed, C. Both A and B. D. Neither A or B. Correct answer is B. Grant deed. A grant deed is a common instrument used in California to transfer ownership of real property. By using a grant deed, the grantor, seller, typically implies two warranties to the grantee, buyer. 1. That the grantor has not previously conveyed the same estate or any interest therein to anyone else. 2. That the estate is free from any encumbrances, liens, easements, etc., created by the grantor or anyone claiming under them, other than those disclosed in the deed. A grant deed is designed to transfer the complete title the grantor holds at the time of conveyance, unless specified otherwise. A trust deed is a security instrument used in California to secure a loan on real property. It involves three parties: the borrower, trustor, the lender, beneficiary, and a neutral third party, trustee. The trustor conveys the property title to the trustee, who holds it as security for the loan. The trust deed does not transfer complete title to the buyer. It creates a lien against the property in favor of the lender. Once the loan is fully paid off, the beneficiary directs the trustee to reconvey the title back to the borrower via a reconveyance deed. Therefore, a grant deed is the instrument used to transfer complete title from a seller to a buyer in a real estate transaction. A trust deed is used to secure a loan. Question 680. The amount of annual property taxes paid by a homeowner is determined by A. Collectively assessing the land and improvements, then multiplying by the tax rate, B. Separately assessing the land and improvements, then multiplying the total by the tax rate, C. Separately assessing the land and improvements, then multiplying by different tax rates, D. Any of the above. Correct answer is B. Separately assessing the land and improvements, then multiplying the total by the tax rate. The county assessor, in California, or the relevant local government agency determines the assessed value of the property. This usually involves assessing the land separately from any improvements, buildings, landscaping, etc., on the land. The assessed value of the land is added to the assessed value of the improvements to arrive at the total assessed value of the property. The total assessed value is then multiplied by the applicable tax rates. These rates are set by the various taxing authorities that levy property taxes in the area, e.g., county, city, school districts, special districts. Often, there is a basic countywide tax rate plus additional rates for specific jurisdictions. Therefore, the process involves assessing the components separately, summing them up, and then applying the tax rate, or a combination of rates to the total.